Manufacturing PMIs just out as ever, 2 minutes ahead of the rest of the market on Reuters Insider. The index hitting 49.6 in December, up from a revised reading of 47.7 in November. That is more than forecast, but still below the 50 no change mark, and the sector registered its worst performance for the full quarter since early 2009. Joining us with instant analysis, Rob Dobson, senior economist at Market, who put these numbers together. Morning to you, Rob. All right, contraction no longer. We're now in that point at that point of stagnation, so a little bit better, but still pretty weak.
Yeah, still a little bit of brighter news towards the end of the year, but we still got that headline figure below 50, output levels stagnated, and new order inflows, they also declined still. So that was mainly domestic market driven though. What we did see that month was a relatively solid upsurge in new export orders to offset that.
Where are exports going?
Well, what we saw sort of in the earlier part of the quarter, we saw exports declining, but we have seen that export orders index, rise quite solidly, and that was mainly driven by sort of economies such as Germany, China, and Eastern Europe.
But I guess not the core, the peripheral Eurozone nations.
Well, no, that's not the case. Again, the manufacturers surveyed were really focusing on those three sort of prongs of where the exports were going. There was also less a sort of reference of the US as being a key sort of driver of export order growth this month. But also, alongside that export order growth, what a lot of manufacturers are doing is they're continuing to rely on the depletion of backlogs of pre-existing contracts, continuing to work through them at quite a solid pace, and that suggests.
And how quickly will they get through those, and how quickly will that then be reflected in a weaker export order number?
Well, that would affect total order books in their entirety. Now, it could take some time for them to run through those order backlogs. There's quite a lot of strong order growth towards the beginning of last year, but it definitely suggests that if the new order intakes, particularly from the domestic market, don't start to improve solidly, that could have a negative impact on production going forward.
And what's this do to Q4 GDP?
Well, manufacturing was obviously one of the leading lights at the beginning of last year. It's tapered off towards the end. With the the PMI output index, new orders indexes, they're all registering their lowest averages since the second quarter of 2009 in the final quarter. This definitely suggests that manufacturing will be a drag on those Q4 GDP numbers.
Job cuts are easing. I mean, we've talked about this before. Yeah. Why does the jobs market look a little rosier here in the UK?
Well, if you're talking about why it's looking a little bit more rosier in manufacturing, again, it tends to be a bit of a lagging indicator, but also we're still seeing job cuts, and what that's suggesting is that manufacturers maintain a certain degree of cost caution, particularly with new order inflows being pretty weak at the moment.
And to finish up with, how much more scope is there for stimulus from the Bank of England, and what do you expect on that front?
Well, there's quite an expectation in the market that the Bank of England will possibly increase its asset purchases sometime during 2012. One of the key indicators of what that's going to be happening is obviously, yes, if economic growth is weak, that would mean that they would probably trigger that. These numbers pretty consistent with that possibly being a case, but also look at the inflation outlook. Now, our figures are showing input prices at manufacturers falling for the second month in a row in December, and supply chain pressures, which are normally a key indicator of future inflation, them easing off a little bit as well. So that also provides a little scope if they feel that a bit more stimulus is necessary.
Okay, Rob, many thanks for that. Rob Dobson from Market. That's it for now. I'm Axel Threlfall. This is Reuters.